Okay, you're looking at the yield curve, and we're using the 30-year minus the 2-year yield. And what that produces is a figure that's normally positive in a healthy economy. You have a positively sloped yield curve in a healthy economy. But there are cases where it goes negative, and that's what you call an inverted yield curve, where it dips below the zero line. That means the 30-year is offering less yield than the 2-year. And in those cases, what economists like to say is the yield curve is forecasting a recession. Now, the little nuance here that I would draw your attention is that when it actually dips negative, that's not the recession. It's it's mostly when you come back above that line. So this is, a little quirk of the chart here that, hey, recession is forecasted when we dip below this line back in February 2000, but it's really full-blown recession once you get back above it by the end of 2000 and going into 2001. That's when the Fed is cutting rates to zero, and the 2-year drops to zero. It's easy for the 30-year to yield more than the 2-year. You're back to a positively sloped yield curve. So it's that reflation trade that gives you that vertical move up because the Fed's cutting rates to zero on the short end. Now, you can see the same thing happened in 2008, and we think the same thing will happen here soon, because this dip below the zero line back here in, it would be 2022, July of 2022, that's when we had the first awareness that a recession might be coming. But it's not here yet, and a couple years have gone by, and you're wondering, then there's not going to be a recession. In fact, a lot of economists are saying, hey, soft landing, no recession, we just keep growing. But honestly, I trust the chart more than economists, and the chart tells us that in past cases, it's not when you dip below the zero line that matters. It's when you come back above it. That's when you get the recession. So 2008, 2007, you're going into recession here, and it's a vertical move up. And the Fed is cutting rates. Same thing here in 1990. Going back here, this is pretty choppy back in 1980. This is a very bad recession. Very messy, but again, it seems to work. So I would say, don't worry about a recession until you get above the zero line. Then worry, it's happening, so that's when you have to worry. Now, one other thing I would point out is that you can actually look to see what the stock market is doing as we cross above the zero line. And it turns out there's a correlation. It's pretty good. If you look at it here in 2007, this vertical move up in the yield curve, very positively sloped, very sharp move up, coincided with, the top in the stock market, the S&P, and it starts moving down. Same thing happened over here. Back in August of 2000, you start moving up, and then by what it looks like the end of 2000, late December 2000 into 2020, 2001, you had this vertical move up, and that's, this is the meat of the recession. So it also forecasted the move down in the stock market. So that's very useful, because if you think about it, the time to be really nervous about the stock market is not here. The time to be worried is when it goes back to normal and the 30 years yielding more than the 2-year. Because that'll probably coincide with the Fed cutting rates to zero and the 30-year might even go up in yield because it's a reflation trade. People will be anticipating higher inflation because QE reflates the whole economy. So I think that's what you need to worry about. And is that, this summer? Is it this fall? We don't know. But I'm just saying, keep an eye on this. When you see the 30-year yielding more than the 2-year, if it starts moving up sharply, well, that's probably about when the Fed's going to cut rates. And, that's also when the stock market is going to crash. So if you look at history, ignore what the economists say because, they're wrong 99% of the time. What you should do is look at the chart and say, hey, the chart tells the truth. It coincided, this vertical move up in the yield curve where it went positively sloped very sharply. That coincides with a peak in the stock market and a big move down. We expect the same thing to happen here soon. And, there are a lot of Gann charts that will fine-tune the analysis. If you're interested, you can go to the website, www.gannanalysis.net. Register, you get a few free reports, and then if you like it, you can sign up for 3 months and try it out. So good luck in your trading. Keep an eye on the yield curve. I think you'll find that when it goes positive, 30s versus 2s, when it goes positive, that's when you need to worry about the stock market.